Welcome back. In this session, I'd like to continue with a series of evaluations I've done in IPOs. Over the course of just this year, I've looked at Lyft, I've looked at Uber, I've looked at Beyond Meat, I've looked at WeWork, and I started this particular session thinking about valuing Peloton. But as I was reading the Peloton prospectus, I had a sense of deja vu. I've always liked that word, but basically I was running into things that I'd seen before. In the Uber prospectus, the Lyft prospectus, the WeWork prospectus, the Beyond Meat prospectus, in things like the total market size, the talk about scaling up, the looseness with the business models, the terrible corporate governance. It felt like I was revisiting the scene of the same crime over and over. So rather than talk just about the Peloton valuation, I'm going to talk about the lessons I can draw from looking across these prospectuses about what these companies are doing and why they're doing it. Because in my view, what these companies are doing is they're reflecting the fact that they were rewarded for this kind of behavior. What kind of behavior? Inflating market sizes, not talking about business models, focusing on these unreachable total addressable markets, and essentially not even worrying about corporate governance. So I thought this would be a good way to get at least an insight into how VCs are pricing companies, notice the use of the word pricing, and what we as investors, public market investors, can learn, both in good ways and bad ways, from this pricing. So let's start with some of the commonalities. The first is these companies, all of them, every single IPO this year, if you look at their business description, it's incredibly grandiose. Now, this is not unusual. If you remember the resumes you wrote when you were 22 years old, you were just out of college, we tended to overstate what we did at companies, inflate our responsibility. So I guess it's natural. In fact, remember when, and it's not just when you do resumes. In fact, I remember when Subway, the restaurant chain, advertised for sandwich artists. And I was wondering, what sandwich artists? They call their workers sandwich artists. Clearly an inflation of what they were actually doing, which is making sandwiches for minimum wages. But companies follow the same practice, but these companies go beyond the pale when it comes to describing the businesses. For instance, Lyft was probably an okay ground talking about themselves as a transportation company. They're a car service company. Transportation is a little broader, but Uber really went over the top and they called themselves a personal mobility company. I don't even know what that means. In fact, briefly, I thought if my youngest son was a big Uber user, needed to go to the bathroom, maybe they'll send somebody to carry him from the bedroom to the bathroom. WeWork in its prospectus does not describe itself as a real estate company. They describe themselves as a community company. Again, I have no idea what that even means. Peloton, in its description, is probably the widest stretch of all, describes itself as a technology company, media company, software company, product. I mean, basically, they don't stop. They have like 10 different businesses they put themselves into. Besides, all of these companies claim to be tech companies, when in fact they're nothing of the sort. They might use technology to deliver their products or services. But if that's our definition of a tech company, we're in serious trouble. So grandiose business descriptions. In the same prospectus, here's how it plays out. It plays out in the total addressable market that they claim they can go after. It's called a TAM. And actually, there's a very solid case to be made that when valuing a young company, you have to access the total addressable market. And here's why. Traditionally, when we value mature companies, we can take past growth and project it out. We can look at big companies in the sector and make that our focus. But with a young company, you don't have that benefit. So often you got to start with the market and work down. And how you define the market can make a big difference in your value. So using a classification I developed a few years ago when I was talking about how you have to check stories for companies, I call it the 3P test. Is it possible? Is it plausible? Is it probable? And here's the way it plays out in the definition of total addressable market. If you're looking at just the existing market for a product, for instance, car service in 2014, I described it as the urban car service market in 2014, obtained by adding up the taxi cab business and the car service business in different parts of the world. Think of that as a constrained total addressable market. And it's basically passes the probability test. But in many of these cases, you can argue, and this was where I was wrong in the Uber valuation in June of 2014, that these companies, these new companies coming in, these disruptive companies, because of the kinds of products and services they offer and how they offer them, could potentially expand the market by bringing in users. Think of that as the expanded total addressable market. It's plausible. Clearly, if you can get new players into the market, you can make the market much bigger. Think of how much bigger Uber has made the car service market. Now, if you stopped at expanded total addressable markets, I'd be perfectly okay with it. In fact, I think it's perfectly reasonable. It's a lesson I've learned from my Uber June 2014 valuation, that with these young companies, it's good to bend over backwards because they do manage to change the market size. But what these companies in their IPOs have done, have they reduced constraint? They definitely are not talking about constrained total addressable markets or expanded. They're talking about essentially an overreach. Let's see how. Let's start with the Uber total addressable market. They called themselves a personal mobility company and claimed that the total addressable market was 5.2 trillion. Right. If you look at WeWork, they claimed the total addressable market was 3 trillion. I guess you got to throw a trillion in there to attract attention. And finally, if you look at Peloton's prospectus, they claim there are, at least in the US, 45 million potential people to sign up for Peloton. This is a service that costs close to $50 a month. $40 a month. And you're going to get 45 million Americans signing up for them? And that sounds like an overreach. Or if you look at, so essentially, if you look at the globe, they're looking at, the numbers in these total addressable markets are huge. Now, I can see the allure of doing this because you want people to invest in you based on the size of the market. But the danger of overreach here is you lose credibility. I mean, 5.2 trillion, come on. Even an optimist in Uber does not believe that the total market is. I think these companies lose credibility rather than gain it by going after these really big markets. So that's the first stop, these grandiose business descriptions and huge total addressable markets. Let's move to the second feature that all of these prospectuses have. They talk about growth and they boast about how much they've grown, and who can blame them? Because these are growth machines. If you think about growth as revenue. So if you look at Uber, which was actually the lowest growth IPO in this mix, 42% growth in the most recent year, from 8 billion to 11.3 billion. WeWork, if you compound that 6-month growth rate they had, is about 103%, and Peloton is even more, 110%. Now, I don't blame these companies for focusing on growth. It is at the heart of their story. And what's impressive about these companies, at least in terms of revenues, they've gone in a very short time from nothing to not just bigger companies, but among the biggest companies in each of these businesses. Uber is the largest car service business in the world, car service company in the world. WeWork is among the largest real estate companies in the world. And Peloton is getting very quickly into the upper ranks of fitness businesses. 2 to 2.5 billion would put you in your Life Fitness or Equinox Gym, and Peloton is halfway there. So the growth is impressive, but what's also striking about these companies, and this is true for not just my 3 companies, but for all of the IPOs, is how much they emphasize unit growth. Like what? Uber talks about the 91 million people who are Uber riders. WeWork talks about the 527,000 members. Peloton boasts about the 511,000 subscribers that it has. And I can see why they make such a big deal of it. There is a platform argument that's implicit here. And here's how it works. We have a platform of users, subscribers, members. And once we have a platform, because they trust us, we can sell them other stuff. And that's not a bad argument. After all, some of the great companies of the last 20 years have come from building off platforms. I think about Facebook using its user platform to essentially sell advertising, but also sell other stuff. And Amazon Prime, 110 million person platform where Amazon finds increasingly creative ways to sell them more stuff. But by focusing on users, you can't forget that there are companies out there that forget the end game. They think the end game is acquiring more users. I call this the movie pass model, which is have an absurd business model, one of the worst in history. And you essentially give away stuff for way less than you should. Of course, you're going to sign up a lot of users, and you tell investors, trust us. We'll figure out what to do with them after we've acquired them. So by focusing on growth and users, again, we're setting the stage for laziness on the part of companies and investors. Third feature that all of these IPOs and their prospectuses share is the business models are blurry. They're very unclear. I don't expect these companies to be, after all, they're still forming business models to be clear about where they're going, but at least I need to figure out that you're thinking about pathways to building decent business models, that you've thought about your weakest links and how you plan to deal with them. And I find in all of these prospectus is a remarkably small attempt to actually talk about their businesses. For instance, with Uber and Lyft, I expected a significant discussion in their prospectuses about what they plan to do when drivers became employees. You could see this coming. So in September, when California passed a law saying Uber and Lyft drivers were employees, Uber and Lyft kicked and screamed, but this is something we've seen coming since the inception of these companies. You cannot maintain the fiction that these drivers, they drive for you 50, 60 hours a week, which is what many Uber drivers and Lyft drivers do. I mean, how can you claim they're independent contractors? With each of these companies, I expected them to deal with their weakest links, their most vulnerable exposures. With WeWork, for instance, it's obvious that mismatch between their liabilities and their assets, the heart of their weakness. I expected them to talk about what they were doing to reduce that, but there was no talk of that. In fact, of the three companies, again, Peloton might have done the best job of talking about, and even it doesn't do that great a job of how it plans to build the subscription business over time and use it as its opening to actually become a money-making, valuable business. The second thing, and this I think is something that's so unnecessary that companies should stop doing it, is this notion of an adjusted EBITDA. You've seen this, right? Where these companies take GAAP EBITDA, which already is all kinds of bad embedded in it, and they make it worse by adding back stuff. Here's a simple rule. Don't add back stuff that's going to be there anyway. I mean, that's the argument I've used against adding back stock-based compensation. Stock-based compensation is not a one-time deal. These companies use stock to compensate employees because they don't have the cash. And guess what? As they become more profitable, you don't stop compensating employees. Why would they keep working for you? You replace the stocks with cash. So there's absolutely no basis for adding back stock-based compensation. But with some of these companies, you see them getting really creative. WeWork did not try this on their prospectus, thank God for that. But a few periods before, they actually reported a community EBITDA, which claimed that they were making almost all of their revenues as profits. So they added back every expense, claiming since they were a community, any expenses associated with servicing the community were really not expenses. Absurd, but this is exactly where this logic will lead you. And finally, the fourth feature shared by all of these companies is what I call founder worship, which is founders are viewed as these special people, amazing people, entrepreneurs. See, I love the entrepreneurial spirit. I think it revitalizes economies, but at the same time, founders are not necessarily people that you want to trust with a company. In fact, the traditional quid pro quo for public markets was if you're a private business and you went public, and this was true until this century. So the Apples and the Microsofts, when they went public, the quid pro was they would list themselves in the market to raise capital. So it gave them access to capital, but in return, investors would have a limited say in how these companies were run, who sat on the board of directors, or whether the CEO could stay on. Limited, but that was a trade-off. Somehow that seems to have gone away, and I call this the Google effect. Since to the Google IPO, where they issued 2 classes of shares and investors are open with it, I mean, we live in a world of benevolent dictatorships. I mean, at least that's the benevolent is what they want you to believe, that the founders are benevolent people, but they need control. They need, because you can't trust public investors with running these incredible companies the founders have built. And here's how it manifests itself. First is, in almost every IPO this year, there have been 2 classes of shares, or 3 classes of shares with different voting rights, where the shares with high voting rights reside with the founder CEO who can control the company without owning 51%. In fact, the only exception was Uber. The only reason Uber did not do it is they had this strange phenomenon of the founder, Travis Kalanick, was removed from his position by a board of directors, which got pressure from VCs who were afraid of their investment being heard. So maybe these companies, you need to remove the founder to stop the founder worship, but that's that's not likely to happen. Second is, I don't know the people who sit on these boards. I'm sure they're really, capable people who know these companies really well. But it doesn't strike me that they're doing a really good corporate governance job. In fact, WeWork was an extraordinary example of how a board of directors can be checked out. I mean, where was the adult supervision when Adam Newman went out there and created these these problems that are now blowing up in their faces. So it seems to be a captive board of directors. And finally, IPOs are always difficult to value because you have multiple classes of shares, you have options, you have restricted shares, you have things coming online. Just getting a share count in an IPO is tough to do. And if you add on top of that complex ownership structures like WeWork, that is really making things difficult. And looking at all of these common characteristics, I have to believe that this is learned behavior, that these companies got to where they are because they've been rewarded for doing what they're doing now, which is claiming these over-the-top markets as their total accessible markets, boasting about revenue growth and unit numbers. That's the big selling point. Glossing over the weaknesses in the business models and really not caring about corporate governance. This is not an accident. It's happening with every IPO. It must be that VCs at every stage that have given the capital of these companies have encouraged this behavior. I think that what we see in the IPOs reflects what the VC market has been pricing and viewed as good, and it gets built into these models. So having said all of this about VCs, you can also see that almost every one of these IPOs, if you look at the pricing pitch they're making to markets, it's actually remarkably simple. They point to the last VC round. For Uber, that was 66 billion. For WeWork, it was 47 billion from SoftBank. These are first extrapolated from small VC investments and 4.2 billion for Peloton. But the starting point is, hey, VCs priced this at this number. And here's how the rest of the pitch goes. VCs are brilliant people. Remember, SoftBank's reputation prior to the WeWork fiasco is it's run by a visionary genius who knows where the growth is going to come from. So the second pitch is, if VCs think it's worth 45 billion and they have all this inside information and they want to make money, well, it must be worth at least 60 billion, right? So if you look at the starting numbers that came out for each of these companies, it's VC pricing plus. Which raises an interesting question, which is, if you're a public investor, should you base the pricing of companies on what VCs are paying? I didn't think so, because VCs play a pricing game. You're saying, what's wrong with it? The pricing game is driven by the metrics that people in that game value. And you saw the metrics here are, hey, am I growing revenues a lot? Do I have a big total accessible market? It doesn't seem to me, can I make money? Or do I have good corporate governance? So the problem with going along with the pricing game is the game shifts. It on its way up, it can push pricing up, as you saw with all of these companies, but on its way down, you saw this with WeWork happen in hyper speed. It can push pricing down. So IPOs are a pricing game, and I understand that, but you can see how the pricing game can set up some really weak businesses up for the pricing. So having spent all of this time, I might as well spend some time on the Peloton business model. The Peloton business model is built around, first, the equipment, which is this upscale exercise bike, costs about $2,250, and an expensive treadmill, which came more recently. But they're not like Life Fitness offering 50 different models. It's actually very limited models. And here's what makes Peloton different from an equipment maker or a gym. First is they're focused on the upper end of the market with very limited offerings. It's not really about selling more bikes. The second is the follow-up once you get a Peloton bike or treadmill is you have a subscription. Subscription costs about $40 a month, and what you get for it is online classes. In fact, Peloton has a good point when it says, look, it's not just the equipment, it's the content we deliver. And they have some, I don't own a Peloton, I'm far too cheap. But talking to people who own Pelotons, they say that the content is really good, that the $40 a month is well worth it. In fact, last year, Peloton offered a lower cost subscription to those people who are not Peloton product owners, but who want to still subscribe to the service to watch the classes. And that costs about $20 a month. That number for the membership is about $100,000. So this is an equipment plus a subscription model. And the subscription part of the model is growing faster than the equipment part. And the company in its subscription, in its prospectus, clearly makes this point that this is where they're going, is they want to make the subscription model bigger. And there are advantages with the subscription model. Is a less capital intensive model. It's a higher margin model. And to the degree that there is a cult following, people who love Peloton who will come back, this is a gift that keeps on giving. So here's what my Peloton story is. I know people use the word cult to describe Peloton users, but that's another way of saying you have really loyal users. Companies would kill to have a cult following them. And I think that that loyalty is based on something real. It's not just a brand name. There is this combination of quality equipment plus the online presence And if you think about their online presence, their TV screens on even though I've never owned a Peloton, I got a chance to check it out, are designed to deliver online classes. They're not these after the fact TV screens that you see on most exercise bikes. So my growth story is going to be a pretty optimistic one. If you look at the fitness market, it's a big one, but it's splintered right now. It's about 30 billion plus in the US, maybe 90 billion globally. I think Peloton is going to draw, and I think it's also not just Peloton, but trend lines in these businesses are going to make the market bigger. The demand for fitness is greater, and the more stuff you can deliver online. And I think Peloton is going to be one of the winners in this game. In fact, I'm going to give them revenues of 10 billion. That's a lofty goal, given the fact that big companies in this business right now are about 2 to 3 billion revenues. I do think the subscription model is going to deliver higher margins to Peloton in steady state. I'm going to give them 15% margins, higher than the typical margins for fitness companies. And I'm also going to assume they can grow with less capital investment than a typical fitness company. You don't have to build gyms. You don't have to make the manufacturing for equipment. The subscription model will kind of keep capital intensity low. And here's what my valuation looks like. The value that I get for the equity overall with my story is about 7.2 billion. And I put in a 15% chance of failure because it's still a small money losing company. Who knows what will tip it over the edge. But to get to a value per share, I looked at the number of shares, and since I used the updated prospectus, the company says it's going to be about 278 million. But they're also pretty open that they don't count 64.6 million options. That's a lot of options outstanding with an exercise price of $6. If you take out the value of those options and then divide by the 278 million, the value per share that I get is about $19.35. The price that the offering prices, and it just came out this morning that the prices were being set between 26 and 29. I'm below that, but I'm actually closer to the offering price with Peloton than I was with Uber and WeWork. But that's damning with faint praise. But I have a worry with how the market and journalists are framing the Peloton valuation. In fact, I heard talk this morning or read an article in the Wall Street Journal that took the $26 lower end of the price and multiplied by the 277 million shares to say, hey, that works out to a market cap of 8 billion. That's not true, because if you bring in the 64.6 deep in the money options outstanding, a $26 offering is really closer to a $9.5 or a $10 billion market cap for the company. So it's actually a pretty high equity valuation for the company. And there's lots of uncertainty in this valuation, and I'm pretty open about it. But there are a couple of pushbacks I've got on every single one of my IPO valuation that I want to deal with. First, there's a group of value investors who seem to dismiss the valuation right off the top. They say, if there's this much uncertainty, I would never buy a company. Really? At the right price, I would buy into a lot of uncertainty. Just as with the wrong price, I'm not going to buy a company even if things are certain. So I don't understand this notion of knocking entire segments out of the market simply because uncertainty is your enemy. The second is, and this is again something I don't understand, is I've been told that you cannot use a discounted cash flow valuation or a DCF to value these young companies. Why? Because there's too much uncertainty. That's absurd. Discounted cash flow valuation just reflects an idea that when you invest in a business, you buy it for its cash flows, growth, and risk. I thought that was a core of value investing. You buy things, and the fact that the cash flows are negative doesn't mean you repeal the laws of intrinsic valuation. In fact, am I uncertain about my assumptions? Absolutely. And I think the best way to deal with it is to actually face up to it. I've done this on other valuations before, but I did a simulation, a Monte Carlo simulation on Peloton, where I let my big assumptions become part of distributions, my revenue growth, my margins, my cost of capital, my three big assumptions, and ended up with a distribution of value. Saying, what do I do with it? The baseline value doesn't change. My median value is about $18.35. My average is about $19, pretty close to what I did with my base case valuation. But here's what I get in addition. The 10th percentile puts me at a value close to 0. And the 90th percentile puts me at a value of 38, which means if the stock goes public at 26. It's possible that it's still, that it's still undervalued, given the uncertainty I feel. But here's what I think the simulation also tells you. Look at the tail of the distribution. It's a big positive tail, right? I'm not a great fan of margin of safety, and I've written about this before. But if you think about a margin of safety I would have on Peloton, that big positive tail means I'll settle for a lower margin of safety. What does that mean? If the stock price drops to $17, so 16 and a half, I would be more inclined to buy Peloton than I would buy a company like Coca-Cola with the same percentage difference. And here's why. That big tail means there's a much greater chance of doubling, tripling your money than with a more mature company. It's like an option embedded in my valuation. It's one of the advantages of doing Monte Carlo simulation. So at 26, would I buy the shares? No. At 16, would I buy the shares? Yes. At 15, 12, I'd be an investor. So as you look at these companies going public, I would strongly recommend that you pick up 10 IPO prospectuses and try reading them. Don't do it all in one day. They're all about 250 pages. But what you start to notice are the commonalities. And basically what you see in those commonalities are what VCs have been rewarding companies for doing. And you know what? They've been rewarding companies that put out over the top total markets, have these that are built on, that can scale up quickly with terrible business models, and you're seeing them all go public. I'm not saying all VCs are guilty of these sins. There are obviously very sensible VCs, but collectively there is a weakness in the VC community pricing, and to the extent that that pricing feeds into companies, we might be building companies that are scaling machines that grow fast but are terrible businesses. And I think you're seeing that come true with some of the companies going public. Thank you very much for letting me share with you what I think about the Peloton IPO, but more generally about VC pricing and IPOs in general. I hope you've enjoyed this session.